afternoon. This is Lance Bryce with Thrive Mortgage. Today is the 4th of May, Thursday. I hope you're doing well. Appreciate the ability to take a little bit of time off. We did not do a call this last week. We were actually down at the coast doing some fishing and did pretty well. So if you'd like to know how we did on that, feel free to give me a call offline and I'll be happy to visit with you some about it. But in any event, here's where we are today. The Fed did as expected yesterday. They moved a quarter of a point higher. That was well priced in, going back all the way to the last Fed meeting where the minutes indicated that they were going to they would be continuing their tightening schedule. So they really met expectations. The one gift that the Fed did give us is that they removed language that was hinting towards additional tightening. So the removal of that, again, these Fed statements are very carefully parsed. So the Fed is well aware that the market will now begin to price in a pause, which they have. So we saw rates rally a bit after the Fed announcement. So here's where we are today. The Mortgage News Daily Index has us at 6.43%. Again, most lenders locally are quoting better than that, and I am as well. So this is not a rate quote, but it is just showing the daily movement, as we always like to say. 6.67 on Thursday of last week, so we're about a quarter point better week over week. If you go back 30 days, though, we were a little bit better off 4 weeks ago than we are today. We were at 6.37% in that same survey. So rates are about back where they were a month ago, or pretty close to it. So in any event, that is where the Fed has taken us. The good news is that it looks like we're in for a bit of a pause on any future Fed tightening, which means the Fed will be hanging on every report that indicates inflation or job weakness or strength. And we have some of that in a big way coming up. Non-farm payroll is tomorrow. The jobs number coming out may well reflect recent jobs reports that show some weakening in the labor market. If that is the case, that will continue to bolster the downward direction of interest rates. The reverse is also true. If that report surprises to the upside, we may well see the possibility of another rate hike from the Fed priced back into the marketplace. Of course, the big report is Consumer Price Index that comes out on Wednesday of next week. The market is expecting a 5.2% year-over-year number. As we get that report, we're hoping to see that shelter cost component that we have mentioned several times. Now that some of those leases, many of the leases that are carrying the largest portion of that, 43% of the Consumer Price Index, is tied to these long-term leases. We know that the year-over-year amount of rents that they are increasing has reduced dramatically from where they were signed a year ago. And as they renew, that's going to start making up a larger and larger component in the reduction of the CPI. Will we see a big piece of that next week? We may. So that report may surprise to the downside, which would be a very good thing for interest rates. So all eyes on that, especially the Fed. I have been asked, y'all, by a number of folks. This video goes out to several hundred people. So I have been asked by numerous folks to address the changes that FHFA, the parent of Fannie Mae and Freddie Mac, issued, that the administration issued through FHFA, that raises loan level price adjustments on borrowers with large down payments and high credit scores to the benefit of borrowers with smaller down payments and lower credit scores. And I want to clear up a couple of things related to this. First of all, the broad outlines of that are accurate. The administration has in fact elected to instruct the FHFA to do exactly that. Now, what's being reported by a number of outlets is that high credit borrowers with large down payments are actually paying higher rates than folks that are in the other category of lower credit scores and lower down payments. That's simply not true. High credit borrowers with reasonably high down payments are still getting far better pricing than folks that are at the other end of the spectrum. So high credit risk borrowers are in fact still paying more for their credit than lower risk borrowers are. So what the administration has done is they have narrowed that gap between the loan level price adjustments on the higher credit, higher down payment borrowers to the benefit of those at the other end of the spectrum. They've done that for political purposes, not market-based or market-driven reasons. That is what is so dangerous about this change. That said, folks, loan level price adjustments that the FHFA is messing with this new rule are there primarily to address the risk of loans. The ability to price to risk is critical to the availability of capital. But if you deprive the lending industry of the ability to risk price the product that they sell, then they will find another way to do it. So the administration has a very shallow view, frankly, unless they're just looking for a headline, which is always possible in this political craziness that we reside in now. They're discounting heavily the notion that we're simply going to have credit not be extended to as many folks if we have to absorb higher risk than the pricing of that product allows us to price in. These loan level price adjustments need to be adjusted for lending risks and not much else. Y'all, the notion that we would be, for political purposes, changing the risk-based pricing of loans will ultimately deny certain underserved portions of the economy credit. If we can't charge, and bluntly, if the industry can't charge appropriately for additional risk, they will just find ways to stop lending in those additional risk profiles because they are guaranteed to lose money as a result. The market needs to set these. The market has done a decent job of setting loan level price adjustments in the past. There are actuaries that carry these pricing models based on default rates. That needs to be where these loan level price adjustments are set. That needs to be the reason that they're set. And additionally, the notion, y'all, that when we've seen borrowing costs go up at the level that they have over the last 2 years, that we would be setting additional fees for anyone in the industry that's looking to get a mortgage is just crazy to me. So there are a number of senators that have signed, or congresspeople rather, 34 Republican co-sponsors of the Responsible Borrower Protection Act of 2023. If you'd like to lend your voice of support to that, then please reach out to your congressman to support that bill. It will reverse these changes to FHFA. I've had folks ask me, is this going to take us back down the same road of 2007? Well, in and of itself, no, very unlikely. But what it indicates, that we would start changing and manipulating the pricing model that's there to establish the best, largest amount of folks that we can lend to based on the risk associated with those borrowing pools. When we start monkeying with that for political purposes, that won't have a good result, y'all. There was a great deal of that led to the mortgage collapse back in 07, 08. We don't need to revisit the methodologies behind that market manipulation with anything that approaches it. So we should learn our lesson from the past and leave these decisions to the open marketplace to assess risk and the price of that risk accordingly. So in any event, that's my weigh in on this. Sorry that this recording went a little bit long. If you have any questions or you'd like to visit with me about it directly, I'm always happy to visit with you. I'm always available to take your calls. I have all my contact information on the screen. Of course, we do these calls in order to hopefully earn your mortgage referrals. That's what we do for a living here. So if you'd like to refer a client to me, reach out to me and we'll make sure that they are well cared for. In any event, stay blessed, stay safe. We will talk to you next week.